So our next adjusted entry that we're going to focus on is called depreciation. And you guys may already be familiar with the word depreciation because you could probably identify or relate to it from your vehicles. Yes, vehicles do get depreciated. And we know whenever a vehicle becomes depreciated, the value actually drops. And it's the same pretty much concept in terms of depreciation for a company. We have certain assets. We have long-term assets, assets that extend beyond a year that needs to be depreciated. Okay, and depreciation is the process that keeps up with allocating or depreciating or lowering the value of that particular long-term asset. Okay, and so depreciation is a little bit simpler than some of your other adjusted entries. And so from that perspective, I want you to understand that whenever you depreciate an asset, it becomes an expense to the company. Okay? And so from that being said, depreciation is a particular adjusted entry that is done solely at the end of the year. And since depreciation happens at the end of the year, you don't require an initial entry. And so you go straight to the adjusted entry because you're technically adjusting that long-term asset. So what do you do whenever you see depreciation? Whenever at this level right now see the word depreciation, you go straight to this journal entry that I'm about to share with you. So you always debit depreciation expense because the expense is increasing for whatever the amount that you have, whatever amount that's given to you, and you always credit accumulated depreciation for the exact amount. Now, accumulated depreciation, and I'm going to put slash asset here. And when I say slash asset, it should be the asset's name. So if we're depreciating a truck, you would debit depreciation expense slash truck, credit accumulated depreciation slash truck. If you were depreciating building, you would debit depreciation expense slash building. You would credit accumulated depreciation slash building. Now, we know that this particular account is a what? Expense, because the last name is expense. So therefore, depreciation expense belongs on which financial statement? The income statement. Okay? Now, let's talk about this particular account right here, this accumulated depreciation. Let's focus on the first word. First word is accumulated. What does accumulate mean? To grow, to collect, to get larger, right? To absorb. So that's what's going on. Basically, this account is accumulating, it's keeping track, it's growing all of the depreciation, it's collecting all of the depreciation, okay? This particular account is a contra account. A contra account. And what are contra accounts? Contra accounts are accounts that affect other accounts. Accounts that affect other accounts. Now, you know you can only affect something in two ways. You can either increase it or you can decrease it. So this happens to be an account that affects another account. Now, obviously, you can take a logical guess as to what account accumulated depreciation is going to affect. It's a contra account to the asset depreciated. So whatever asset that you're trying to depreciate, whatever asset that you're currently trying to depreciate, this accumulated depreciation is the contra account to it. It's going to affect that asset. See, so basically, if we're trying to depreciate equipment at this level, then this accumulated depreciation account is going to collect all the depreciation that happens for this particular equipment throughout the life and hold it in that particular account. And it's going to cause that equipment value to do what? Go down. So this is a contra account to whatever the asset is that's being depreciated, and it causes it to decrease. Okay? So let's do a quick example. December 31st. Suppose that we depreciate a building we depreciate a building for $10,000. So suppose that we depreciate a building for $10,000. So we know we're depreciating the building, and we know we're depreciating it for $10,000. Okay? But let's further assume that the initial cost of this building was $100,000. So let's assume that the initial cost of the building was $100,000. We've already recorded the purchase of the building. We've already debited the building for $100,000 and credited cash. So on our ledger, the building is already sitting on the books at $100,000. Now here's what you need to understand. The building will stay on the books at $100,000. That number will never change. The building will never decrease its value from $100,000. Then you may ask yourself, well, how are you going to depreciate it? Through the contra account. The contra account is like the little baby that stores all the depreciation for the building. Okay? So, how are we going to journalize this depreciation right here? We're going to debit depreciation expense / building. And we're going to credit accumulated depreciation / building. For how much? $10,000. Okay? So now we have a depreciation expense for $10,000. Now we have an accumulated depreciation building for $10,000. Okay, all I did was post to the ledger. Okay, now you may want to know, how will we be able to know that this asset is being depreciated? Well, the asset is going to be depreciated on the balance sheet. The balance sheet will report this building at its book value. So, when it's time, I'm going to erase this. So when it's time to do your financial reporting, when it's time to report your balance sheet, and you have to show your building, you're going to do it such as, you're going to write the word building, right? You're going to report your building for the cost, which never changes, the $100,000. But directly under it, you're going to list the accumulated depreciation, the contra account. Accumulated depreciation / building for the amount, which is a total of $10,000. And obviously we're going to show the effect. So we know that accumulated depreciation does what to the building? It decreases it. So now we have our book value. It's called book value. For $90,000. And this will continue every year. And when it's time to report the balance sheet, you will always add your accumulated depreciation at the bottom by subtracting it to calculate the book value. So this asset is currently worth $90,000 because it was depreciated by 10. Every year that you depreciate it, this accumulated depreciation grows, causing the book value to go down.